Welcome back to the Wall Street Podcast. Today we're doing a deep dive, pulling key insights from the Wall Street Journal's reports, September 13th and 14th, 2025.
Right, covering some significant shifts. We've got AI investment, some regulatory jitters, and changing investor behavior.
Exactly. We want to really distill what matters from these pieces for your perspective.
And it's interesting how these threads, AI, health regulation, investor psychology, they seem distinct, but they actually weave together.
They really do. There's a theme of maybe big capital, high risk, and rapid reassessment running through it all.
That's a good way to put it.
Okay, so let's start with that AI investment frenzy. The journal details OpenAI's, well, frankly, staggering financial plans.
Staggering is the word. We're talking, what, projected annual spending around $60 billion for computing from Oracle alone?
Yeah, and another $10 billion on custom chips, plus an $18 billion data center project, new hardware. It's huge.
And you saw the immediate market reaction, right? Oracle's value jumped over $240 billion.
Tied significantly to that big OpenAI computing deal, roughly $300 billion over 5 years.
But, there's caution baked in. OpenAI CEO Sam Altman, he even mentioned the dot-com era.
Right, warning that some AI startups and their investors are likely to get burned.
And OpenAI itself, they expect to lose $44 billion through 2029. That's their projection before hitting profitability.
So it's a massive long-term bet, a really high-stakes gamble fueled by incredible amounts of capital.
Definitely. And the work culture described, founders working 7 days a week, it underscores those high stakes.
Okay, shifting gears a bit, but maybe related through that lens of risk and market reaction, the health sector.
Ah, yes, the Kenvue situation.
What struck me was the interim CEO, Kirk Perry, directly meeting with Health Secretary Robert F. Kennedy Jr.
To challenge that planned report linking acetaminophen, Tylenol's main ingredient, to autism.
And the market didn't wait for the report. Just the news of Kennedy's intention, reported earlier by the Journal, caused a big hit.
A 9% drop in Kenvue stock in a single day. It just shows how sensitive markets are to regulatory noise, even if it's contested.
And Kenvue is pushing back hard, right? They're citing global regulators, a large Swedish study.
Yeah, that Swedish study looked at 2.5 million children, finding no increased risk from prenatal acetaminophen use. They maintain there's no clear link.
It's complex, though, because while federal lawsuits were dismissed in 2023 for lack of evidence,
state lawsuits are still out there, so the issue isn't completely resolved, legally speaking.
So from huge AI bets to these sudden pharma shocks, there's this undercurrent of, evolving risk appetite, which brings us to investor behavioral.
And we're seeing a definite trend towards, let's call it, chasing faster, maybe more speculative returns.
The data points are interesting. 28% of new ETFs tied to just a single stock. That's concentration risk right there.
And 25%, a quarter, are leveraged ETFs using debt or derivatives to amplify returns and losses, of course. Much higher risk.
It suggests that for some, the traditional buy-and-hold approach feels like, quote, a waste of time in these market conditions.
And it's not just retail, is it? Even members of Congress, like Ro Khanna and Rob Bresnahan, reported hundreds of trades via their advisors. Frequent trading seems widespread.
It really blurs that line, doesn't it, between investing as an enterprise, patient, long-term wealth building,
and investing for entertainment. More about the short-term thrill, but with significant risk attached.
Okay, let's crystallize some of this. Thinking about OpenAI and the AI boom, what's the core risk or tension we should be watching?
I think it's the combination of those enormous capital needs, the very long profitability horizons, and this speculative, almost dot-com feel to the environment.
So sustainability questions, valuation concerns.
Exactly. There's a real risk of a shakeout. Who has the deep pockets or the right partnerships to survive? It raises questions about sustainable valuations for everyone else.
And turning to Kenvue, what's the takeaway from that sharp market reaction to regulatory uncertainty?
It clearly shows that perceived regulatory risk can hammer a stock, regardless of the underlying scientific consensus at the moment. Perception becomes reality for the share price.
So companies need really robust comms strategies.
Absolutely. Proactive corporate and public relations are critical. And for you as an investor, it means factoring in this perception risk, especially in regulated industries.
Right. And finally, this rise of what you called entertainment investing. What are the bigger picture implications?
Well, widespread, short-term speculative trading, especially with things like leveraged ETFs, it injects more volatility into the system.
Potentially destabilizing.
It can be. It could erode wealth for individual investors caught on the wrong side. It impacts long-term capital formation if everyone's just chasing quick flips. And yeah, it could affect overall market stability.
So thinking about the average person, how does all this connect? The AI boom, the Tylenol debate, the market speculation.
Well, AI advancements could genuinely transform daily life, services, products. That's the promise. But the financial instability risk underneath could impact the broader economy that affects everyone.
And the regulatory debates, like with acetaminophen, they directly touch public trust in common products and health guidance.
Precisely. While the allure of quick market wins influences personal financial choices, maybe tempting people into risks they don't fully grasp, with real long-term consequences for their savings.
So these aren't isolated stories. AI's big bets, pharma's regulatory hurdles, investor psychology shifts, they're all interconnected.
They paint a picture of a really dynamic economic landscape full of both opportunity and significant challenges.
Which underlines the need to stay informed, to understand what's driving these trends, and crucially, to distinguish long-term strategy from that short-term market noise.
Couldn't agree more. Discernment is key right now.